Sam Hardy, joined as always by Nick Stenger. We are Stenger Family Office, and for the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Bullish, as you know, is our quarterly earnings show. As they come out, we'll be covering them weekly. This week we had a lot come out, so we're kind of covering half this week, half in next week's episode. Remember that everything we talk about here is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks we discuss, and for a full disclosure, visit StengerFamilyOffice.com. This week we will be covering SoFi, Caterpillar, Uber, Ecolab, Starbucks, Merck, Altria, Pfizer, JetBlue, PayPal, Yum, CVS, Carlyle Group, Qualcomm, and National Retail Properties. Before we get into SoFi, Nick, any commentary?
Good morning, Sam. How are you doing today? We had a wonderful barbecue as a team at my house after I was responsible for one human life, my son, over the entire weekend, my wife's first trip since having the baby, and I have to say I did pretty well. I'm very proud of myself for keeping him alive for 4 whole days, and very, very impressed with that. But definitely showed me how much my wife really does at home, not just saying that it is tough. So shout out there, Jamie. Very, very hard work. Thank you for all you do.
Yeah, no, it's very, very sweet of you to throw out there. We all know how hard they work at home, but let's get into
Sam,
it here.
Before you jump in, I will just say also your one son either looked like he had chocolate on his face or mud, so I think it's safe to say he had a fun time too.
Oh, absolutely, and it was 100% mud. He was playing monster trucks in the dirt pile that you had back over there after the backyard was looking great, and he decided to make it his playground. So it was safe to say he had to take a quick shower before hitting the sack because he was a mess, to say the least. But it means he had a good time. So that's wonderful. Yeah, let's let's jump into it. We've got SoFi, personal finance and online banking, CEO Anthony Noto. It was very upbeat with good reason to be. They had net revenues up about 37%, driven by their strong tech platform and financial services business this past quarter. Adjusted EBITDA for them was up about 278%. Why, you might ask? Well, they added 584,000 new members to a total of 6.2 million. They saw a 44% increase there. So total deposits up about 26%. They've seen about a little more than half of their newly funded accounts actually being set up with direct deposits. So they're going to keep having that money rolling in. And then it's also creating some positive cross-buy trends for them, things like their lending and investing services. I will say I pulled up the stock. If you look at what it's done the past week, it was down about 19.5%. Now it had climbed about 120% up to this point as of last week. So coming down just a little bit off of its
SoFi
highs.
is a really interesting story, and it kind of fell into the whole craze with Robinhood and a couple of the other, I guess you could call them fintechs or something to that effect. And they did a great job in marketing. I remember hearing SoFi ads like literally 10 years ago. Like they've been, maybe it wasn't 10, I don't know how long ago, but it's been a while. And they've built up just a massive base. And this is what I always think is interesting, especially in the financial services business, because money, when you start with, 1,000 or 2,000 or 3,000, whatever these people are starting with, their member base or whatever they call it, it grows quickly. Because if you start with a $10,000 account, let's say in investing, and then it goes to 20,000, effectively that's a double in AUM for them. And so they were really smart from the beginning by just building the base, by building volume. And it's hard to believe, but the first quarter of 2020, they had 1 million members, just over 1 million members. Now they're at 5.6 million members. Absolutely insane growth. And so they've just become in that zone where they're headed towards some sustainable profitability. I would expect that to continue because of the scale they have. And this is what you want to do for all the startups out there, for all the companies, if you're trying to decide between are we going to go after volume or quality. I almost think in a business like this, you go after volume and then you figure it out later. And that's exactly what these guys have done. And it's been very, very successful. You look at the business model, they have a really, really good strategy to get people in the door. They start with student loans and refi, and then they get people to consolidate some of their loans from other places, and then they use that to sell them other products. And it's a very, very good vertical, and it's a really interesting business model. So, great quarter there, like you said. Stock's up quite a bit. But I still think you could buy it here and still get in at a reasonable price. I think today it's down 3%, but who cares? You know, the thing is only worth it's just under 9 billion market cap. I still think it's undervalued.
Great. Next, we had Caterpillar. Very strong results for them. We saw sales revenue up about 22%. If you look at that by segment, there are three main segments. You saw energy and transportation up 27%, resource industries up 20%, and construction up 19%. They had operating profit up about 88% to a profit margin of about 21% roughly, and then profit per share was up about 81%. So strong results for them. I know that the stock popped a little bit following the results. It is down 3.5% since earnings came out last Tuesday. But give us your thoughts there.
Yeah, the Caterpillar is one of those just unstoppable companies. I really like it as a long-term hold in the portfolio. As you know, Sam, we're buy and hold investors, and we like to hold stuff as long as possible. And that's one that would fit in with that story. That's a stock I believe. Now, again, none of the show is investment advice, but this is one of those stocks where you could hold it into perpetuity and do very well with it. A lot of these industrials are trading for record all-time highs at this point. Caterpillar is just made a new high, which is hard to believe. I think, like you said, they're off a little bit, but it's very, very close to its record all-time high. From a valuation standpoint, that's where you could have a little volatility. You could see some things adjust there, but it's not radically overvalued. It's really not, you know. And I think Caterpillar, John Deere, a lot of these industrials that are involved in ag tech and things like that, that's what these are. These are almost tech companies today because of the way that they build the machines and the equipment. And you get in one of these, I don't even know what they are exactly, but it's like an alien spaceship, you know, going basically harvesting corn nowadays. So it's pretty cool. And so I like it. I like Caterpillar. You get a little bit of a dividend there too, and that should definitely be a long-term hold, I think, for patient investors.
Great. Yeah, the tech really is incredible in those things. Next, we had Uber, which most notably they posted their first ever operating profit thanks to monthly active platform users being up about 12%. They had trips up 22%. Gross bookings were up in their mobility sector, up 25%. Delivery up 12%. Those are their two, largest, as we're aware, kind of money-making machines. They do have a freight and logistics arm, which is much smaller, but that was down about 30%, so it didn't necessarily affect the numbers too much. If you look at it from a growth standpoint, they were still up 16% overall. Revenue up about 14%, EBITDA 150%, and they got free cash flow up about 200%. So moving in the right direction there. Since last Tuesday, stock was down about 3.8% since the release. And I'm just reading through. We had Reuters. I had said it incorrectly the other day, and certainly got to hear about that. So I said Reuters. I'm calling myself out. We're Reuters, bringing up Lyft as a competitor.
And by the way, it's pronounced Uber. It's pronounced Uber, not Uber, just so you know.
I didn't say that. But anyways, part of the reason they might be down here, Lyft, can still be really competitive on pricing. So they don't have a monopoly.
It is very strange. Uber is in this world where, and I will say, I love the product. I'm a big time user. It's great. Nobody wants to go back to cabs unless they have to. So Uber's fantastic. As an investor, though, I hate it. It's a terrible company to own. And I think they've got a lot of headwinds, which is shocking from the standpoint that it is there's only a couple players in this industry. There's Lyft, there's Uber, maybe there's a couple others out there, but those are the only two that anybody can name. and it's got to be a surprise, I think, to everybody that this thing can't take off. And I think the reality is it really is just a taxi service with an app, and I think that's what they've had to battle from a valuation standpoint. That's what they've had to battle from a scale standpoint. And I pulled up an article from the IPO. At one point they thought this thing was going to be worth 120 billion, and a couple years later now it's still only a $91 billion company, which is still big, but it really hasn't moved off of its IPO price. So look, I'll always be a user. As an investor, it's really tough. I'm not a huge fan.
All right. No, that's fair enough. Thanks for that. Next, we had Ecolab, water and food safety company. We know we see them everywhere. Saw an increase in sales, up about 8%. Net operating income up about 14%. Earnings per share 6%. CEO Christoph Beck mentioned year-over-year price kind of began to ease for them. Obviously, they'd been hiking with inflation. They had to stay competitive there, but still remained, strong as far as volume goes. I know he mentioned seeing life sciences and healthcare as a strong driver of growth moving forward that they're going to continue to invest in. Their biggest headwind right now, or one of the ones they mentioned, was interest expense for them up about 39% as a result of these higher rates on outstanding debt for them, and stock is down about 75 bips since
Ecolab is a really cool story because there's not a whole lot of investing around the water space. That's really what it is. That's the long-term story. Is it's a water company. My mom worked for Nelco at one point as well, and that was a huge acquisition they made. That was probably one of their best. I think that was one of their smartest moves that they made as a company. And water, I think, will be a decent investment. But from a valuation standpoint, it's very richly valued, a 44 price to earnings ratio. And I would just be eyes wide open going in at those prices. Now, it could easily trade at that for a while. I don't think there's any reason to believe that's not going to be sustainable long term. But the stock really hasn't moved much the past 5 years. It's up 25%. Market's up 60. I'm talking price returns now. So that's where some of the risk is I think if you could fall into overpaying for this company because there's so much attention around water. And certainly Bill Gates is like one of their biggest shareholders, so that should tell you something. He's invested heavily in farmland, water, all these rare, or I guess limited natural resources. So these are the things that we like to look at. But again, you don't want to go in and pay the wrong price. So exercise caution. I do like it long run if you can get it for the right price. But it's a little rich here, in my opinion.
Okay. Yeah. Next, we had Starbucks. Global sales increased about 10% for them. This I found interesting, and it does make sense if you think about it, but 75% of sales that they have are cold beverages. I guess it's just harder for people to make at home. So that was it's not really relevant to the earnings, more just an interesting stat that I saw. 7% of that increase was in North America, 24% internationally. China saw almost a 50% increase, actually. So they added about 600 new stores. Total count now is just over 37,000 globally. They did see an increase in their loyalty program. Net revenue was up about 12%, and operating margin, they were able to boost about 150 basis points to 17%. Earnings per share were up 25%. So stock is basically flat since last week, up about 25 basis points. Give us your thoughts there. I know sentiment on the earnings that sales were a little bit weaker than they have been in the past. So it'll be interesting to see what happens. I know a lot of that price appreciation was from them keeping up with inflation as well.
Well, first of all, Starbucks is the McDonald's of coffee. It's just massive. It's such a great brand, and that's something that it's going to be very tough to compete with. It's like Nike, they're making shoes, but because it has the swoosh on it, people will pay extra. Starbucks, you go in there, we were talking about Uber. You could Uber your coffee to your house for like a $20 for a large or something, or what do they call it, a venti?
And I do know people who have done that.
Yes,
Daily.
I am the opposite on Starbucks as I am on Uber. I love being an investor. Don't want to really be a customer if I don't have to be. You walk out of there for $15 for 2 coffees. That's pretty insane. But that's why the stock is where it's at. All the growth long term is going to come from international. You saw it with the same store sales numbers up 7% in the in North America, up 24% internationally. That's the long-term growth story. So if they can continue to push new stores into these places, India is a massive growth opportunity. Obviously, China is this massive growth opportunity, and certainly a big place that they do business. So I think that's really the growth story with something like this, and not as much in the U.S. So don't just buy it because of the U.S. stores. It's really going to have to be China, India, Japan, some of these places that have just a lot of emerging growth potential.
Okay. Yeah, no, that all makes sense there. Next, we have a couple of pharma companies. So both Merck and Pfizer came out last week. Sales for Merck, and we can kind of lump them in together. Both very similar stories. Sales for Merck were up about 3%. They saw large growth in their drug designed to help certain types of cancer. Sales there up about 19%. Drug against HPV saw sales increase about 47%. Now, they did then have their Lagavrio was a drug against COVID-19 infection. Sales there were down about 83%. I know for Pfizer, they have a drug similar to this. Sales for them were down about 53% in that. And so, you see both these companies continuing to adapt. They're coming down off highs from COVID and seeing obviously a large decrease as caseloads have come down in that and continue to stay down. So sales growing slowly. Merck, I know, had an acquisition of a big autoimmune disease company called Prometheus Biosciences, which totally tanked their earnings for the quarter. They were down about $6 billion because it was a $10.8 billion acquisition. So both of them are basically flat, down a little bit since last Wednesday.
Well, since we're talking about both of these companies at the same time, I'll just make a comment on the overall healthcare biotech sector in general, and that's the fact that these things, once they get so big to the point where we're not just talking exploratory. Obviously Merck's not like exploratory anymore. Neither would Johnson and Johnson or Pfizer or any of these. They obviously do a lot of R&D, a lot of development of new drugs, but most of the growth comes from acquisition, and that's the story. So if they can acquire successfully, if they can get in and find the right drugs and buy them, then it works out. But that's the problem they all face. Now, Merck has been one of the best performers out of all of these major pharma stocks. Merck's up 66% the past 5 years, not including the dividend. Johnson & Johnson's up 31.5%, not including the dividend. Pfizer's up, or actually down 10% the past 5 years, not including the dividend. And then we go down the list. Abbott is up 70%. That's been one of the best performers. AbbVie, the spinoff, is up 55%, not including dividend. GSK is down 16%. Novartis is up 42%. It's just such a wide spectrum. AstraZeneca is up 76%. Some of that was with the COVID stuff. So, I mean, this is the problem with these pharma stocks is you just have to own a lot of them to really have the diversification you need. But I'm a huge fan of owning the biggest and the best. And so Merck sitting at a $266 billion market cap makes it one of the best and strongest names. That's why I like it. And not to mention you're getting a 2.8% dividend along the way. These are the types of farmers I think you want to own. Pfizer, we'll talk about that, I guess, too. I don't know if you have any comments there, Sam, but Pfizer, to me, actually represents a buying opportunity. And so whether you got 17 shots or 0 or 1 or whatever you got, that whole craze is over. The COVID craze and frenzy, people are still getting COVID, but the bulk of the COVID sales are really down. And so you can come in today and buy Pfizer cheaper than it was 5 years ago. That's the reality here. That's why I like some of these to come in, and I wouldn't overdo it. You have to be very diversified. You have to be careful with the names you're owning. But look, they have a lot more than just COVID drugs, and maybe you can speak to that, Sam, about didn't they do they're going to do $50 billion in non-COVID sales?
Yeah, it was somewhere around there, and I read something else too about how, to your point of the continued research and development for them, and maybe part of it and part of the reason that they have so many new products coming out is they're acquiring companies that have found a niche and created something unique that's helpful. But they have 19 new products coming out in the next 18 months, so obviously they're not just dependent on what happened during COVID. They saw a great great boost during that, but that's not just everything that they have. It's not their only bread and
Yeah,
butter.
and I think look at the earnings per share. They're still making a ton of money. The fact that this thing is trading at a 9 price to earnings ratio, I think people are really missing the entire picture here. That's why I like it. It's still a $200 billion stock. It pays almost a 5% dividend. I think it's a decent buying opportunity.
Okay. Yeah, no, that's helpful there. Let's do Altria next. Still dealing with issues from some of their involvement with Diehl. For those who are familiar with that, net revenue for them is down about 0.5% year over year. Adjusted earnings per share, they were still able to get up about 4%. They completed an acquisition of Enjoy Holdings, about $2.75 billion was the valuation there. They may need to pay an additional $500 million if certain FDA authorizations occur. This is kind of like Diehl 2.0 is what I called it. Enjoy seems very similar the way it's marketed, but they're just making sure they do it by the book so they don't get in trouble. Headwinds for them, obviously inflation and a large increase in price of gas has created less people at the pumps, and as a result has kind of hurt sales at where you find a lot of these products. So stock for them was down about 2.5%.
Yeah, Altria is a tough one, and it's like dividend investors love it because that's the only return, 8.5% dividend yield. That's basically the long-term story. I don't actually own this one, and the reason is it's like, where's the growth going to be long term? I guess juuling or vaping or whatever, that thing's kind of a big deal. But there's so many regulatory burdens. There's so much hate for these companies. I just think it's really tough to push valuation. So over time, I think what you'll see is sort of flat or declining revenues, and so the only way to grow the earnings is just to cut. And anytime you get into a company where they have to cut to grow, it's really a tough long-term investment. So look at the stock price, down 25% the past 5 years. Philip Morris, their competitor, is up 17.5%, which is nothing to write home about. So these companies just face a lot of headwinds. That's why I'm not a huge fan of investing in them.
Okay. Yeah, no, that's a pretty straightforward one there. Next, we'll hit JetBlue. We haven't covered any airline stocks yet. Let me just get up. Sorry, wasn't loading here for me. So for them, it was their highest quarterly profit since 2019. Increased capacity about 6%. Increased operating revenue about $2.5 billion, an increase of 6.7%. Guidance for their revenue and earnings per share for Q3 were both down, which stock since then is down about 7.3%. So I know they're doing a merger with Spirit, but any comments
So I'll
there?
go back to Uber, and then I'll go back to Starbucks to answer your question here. Uber, I will be a customer, not an investor. Starbucks, I'll be an investor, not a customer. And JetBlue, I'll be neither. So, I guess, look, in the business of shuttling people around for very cheap, JetBlue is probably one of the better names. I guess, Spirit, is okay too. I just can't stand flying either of those airlines, and so, for me, I have zero interest in the stock. Airlines are just a terrible investment, and you never make money on them. At least I guess I shouldn't say never. Never say never. Maybe once in a while you could make some money, but even Southwest, which was the darling of the airlines for the longest time, they stepped on a giant rake, and now the stock's down 45% the past 5 years. So how do you justify owning this long term? I just don't think you can. I think you'd be absolutely insane, and down 64% the past 5 years. I mean, come on. Like, if we did that for clients, we would be working at JetBlue right now. So I think that's the problem there. Please, I would just urge caution. Please be cautious with airlines. They have a very, very long history of making $1 billion and then losing $1 billion 6 months later. So I'm not a fan. They're so regulated. It's just such a highly regulated business. I again urge caution here.
Yeah, well, you don't have a grudge against Southwest or anything like that for ruining your holiday plans one
Well,
year
I don't like
or
Southwest at
anything,
all,
so.
and they're look. not only do you not know where you're going to sit, but sometimes you do know where you're going to sit. You sit down and then the plane just doesn't go. This is the problem. And
Yeah.
people now, they did try to buy us off with 50,000 extra points. I'm like, I don't even want them. Please take them back. I don't want to be stuck on a Southwest flight.
Yeah.
But I know people like it. My wife she took Southwest to Austin. It worked out fine. So I guess I shouldn't hate them that much. We missed our family vacation thanks to the big mistake in what was that, Christmas last year. So anyways.
Yeah, it was last year, 2022. Yeah. Anyways, all right. Let's. Sorry to bring that up. I know it gets you a little heated sometimes. So we'll do PayPal next. We covered Visa and MasterCard last week. Somewhat similar. We saw total payment volume up for them about 10%. Where those guys saw larger cross-border trade, PayPal was only up about 3% there. Transactions were up about 10%. They did have active accounts down about 0.5%. Mentioned strategic decision moving forward is focusing on activity levels of the current users that they have. Revenue was up about 7%, operating margin right around 21%, and earnings per share, they got up 24%. If you look at the stock, though, down about 16% following the release. Biggest thing that I was reading there was their transaction take rate, which measures how much money they're making from each transaction on average there. So, it's something that analysts really look at as an indicator, and that was actually down 6% year over year. So that was a cause for
PayPal
concern.
right now is a value stock, and people that don't see that aren't looking at the true numbers. It's such a dirt cheap company right now. Maybe there's a reason for that, and I'm missing it. Who knows? That's always a possibility. I'm sure I'm going to say this, and then next week it'll go down 20% or something. But look at the numbers. Just look at the raw numbers. 17.5 current price to earnings ratio, 13 1/3 forward. It hasn't traded at these levels, I don't think, ever. The last 2015 it traded at a forward of 24. 2016 it traded at a forward of 22. But most of the time it hovers around 30. The 5-year average is 35 price to earnings ratio. You can buy this thing forward 13 1/3 times forward earnings. It is dirt cheap. I guess they could go out of business. I guess something terrible could happen. I don't see it in the numbers unless you see something, Sam, that I'm missing. $7.3 billion of revenue in the quarter. Huge. Absolutely massive. And they're profitable. It's like a tech and a fintech all rolled into one, and they're making money. I mean, you can't ask for anything else. The operating margins are a little tight, but I think they're going to go up, and earnings are strong. So I don't know how people are missing this one. I like it. Again, don't overdo it. I'm not giving you stock advice, but I do like the stock quite a bit.
Yeah, I mean, it's if you look at the 5-year number, look at how far it's come down since its peak in 2021. So, to your point, trading about half the PE ratio right now. All right, let's hop here into Yum Foods. This is a fun one. I'm a little disappointed you didn't have any, like a bowl of KFC waiting for me. So sales increase for Yum was about 13%. KFC led the charge there with a 19% increase. Taco Bell was up about 7%, and Pizza Hut also up about 7%. Operating profit across the board was up 4%. That was largely due to KFC and Taco Bell. Pizza Hut's operating profit was actually down a little bit, so have to keep an eye on that. But earnings per share overall was up 18%. Stock's basically flat since the release. So I think it was maybe up 0.5%.
Yum is, and for everybody, I think everybody pretty much knows this, but like you said, KFC, Pizza Hut, Taco Bell, which I haven't seen a Pizza Hut in years, which is a bummer because that was a fun place. But if it's 2 a.m., you're a little hungry, you've had too much to drink, you may stop at one of their restaurants, you may hate yourself the next morning. But the stock has done very well, up 63% without the dividend, price return only the past 5 years. New York State Common Retirement Fund just added to the position. We don't own it in the portfolio. I don't know why we don't. Maybe we should be looking at it, but it's done very well. And this is one of those ones where when inflation is high, when times are bad or not that great, this is where people go. It's like Domino's. Domino's is always going to do well in these bad times. I think Yum Brands does well in these tough times. People are going to go to these places. You can't go to a restaurant nowadays without spending $50 for two people. That's bottom line. We went out to breakfast the other day. It was $48 for eggs and bacon, you know? And so people, I think, are going to go to these places where it's a little bit cheaper, a little bit easier to get a family meal.
Okay. Yeah. Thanks, Nick. Obviously, yum food. Who doesn't love a crunch wrap late at night? So I agree with you there. That's usually where I go to versus the pizza, some Los Doritos, or whatever they're called, the Doritos Locos Tacos. I went and saw my brother a month ago down in Indy, hung out with some of his friends, and I felt a little bit like a degenerate going to Taco Bell with them. But I will say I did really enjoy the crunch wrap and those tacos. So that's my one for the year. Maybe we'll see. Next, let's we'll jump over to CVS. Revenue growth for them was up about 10.3%. They completed an acquisition of Oak Street Health, which is supposed to help them kind of deliver on adding primary care capabilities. Adjusted earnings per share was actually down 12.6 for them. So they saw an increase in total revenue across healthcare, health services, and their pharmacy sections. Health services was the only one that really had positive operating income at the moment. They saw income down about 30.7%. That was the large, or the culprit of that was a $500 million restructuring charge that was actual acquisition related. So, they had also sold off a company for, I believe it was $225 million roughly the year before. So that was kind of the high that they were being compared against. But stock was up, meager 1.25% last time.
CVS struggles from the same thing. Walgreens struggles from all these pharmacies, all these convenience stores. It's the fact that there's just not a lot of scale. I mean, once you max out the store, you've got your 10,000 square feet or whatever these stores are. That's it. That's all you got, So the only way you grow is you open up another store, which is capital intensive, and with interest rates where they're at, it's even tougher. So I have never really liked the pharmacy sector, especially like Walgreens. Look at their stock down 55% without the dividend the past 5 years. CVS basically flat. I think there's partially something here with mismanagement. I think I know we're not talking really Walgreens today, but Walgreens should have done what CVS did, and that was the one good thing is they pivoted towards clinics. They pivoted towards point of care or whatever they call these things, and people can walk in, they can get it. I've actually done it. I've had a eye appointment at a CVS. It worked out fine. I think they're doing more. Obviously, Oak Street was an easy way to get into that because they've got these clinics all over the country that are I think probably the future of healthcare, especially as you think about getting healthcare to the rest of the country that may be underserved. This is a great way to do it. I think just from a investing standpoint, it's going to be very tough. Oak Street Health does definitely make it a lot more interesting. But I just don't think there's a lot of innovation in these companies. And then every time Amazon comes out and threatens to get into the pharmacy business, these stocks go down 20-25% in a couple weeks. So very, very tough long-term investment. Maybe you buy it for the dividend and hope it works out. But again, look at that current price to earnings ratio is at 32. I don't know what we could pull up the forward here, but it makes it very tough to invest in these things. It looks like the forward PE is 10, so maybe you buy it and think that I'll get my 3.5% dividend and cross your fingers and hope it goes back up. I don't know though. It's a tough one to own.
Yeah, no, that makes sense there. Next, we've got Carlyle Group, private equity firm. Total AUM for them increased to $385 billion under management. They had fee-related earnings of $200 million roughly, which was actually a 12% decrease year over year. Saw an income loss of $100 million. They had not the greatest investment in a company called Fortitude, so they lost $100 million in the dilution of those shares, which they pointed to as the reason for that. So I know that they kind of struggled on the way up with some of this peak inflation, and as we start to see some chop in the waters here, they certainly feel like they're positioned to best take advantage of that. Stock here is down about 7.6%.
I actually really do like these private equity and asset management companies. Not all of asset management, but select names have been good. I mean, look at KKR's up 143, pays a dividend, not much, but it does pay a dividend. Apollo's up 50% the past 5 years, and now Blackstone's up almost 200% the past 5 years. This is one way to get access to the private markets without actually having to be in a locked up fund, which I do think has some problems with it. So it's not terrible, but Carlyle has just been one of the dogs. I mean, it's not terrible. The stock's up 40% the past 5 years, but it's it's definitely a laggard in the space, which probably presents some opportunity. I like it from a dividend standpoint. You get 4.25, and it's actually reasonably valued here. So I don't mind putting maybe 1 or 2% in it, but I just kind of understand the cycles. A lot of you got to watch operating earnings rather than investment earnings on these things. That's where the valuation comes into play. Just kind of like I know we're going to cover Berkshire. I think next week, Sam. So
next week, yeah.
That's another one where you can't just take the earnings at face value. You actually have to look at the operating earnings and make sure that operating earnings are growing, and it's not just investment losses or investment gains that are moving the stock around.
Okay. Yeah, no, that's fair enough. While we're on that topic, you want to do national retail properties, and then we can close out with Qualcomm? All right, so national retail properties, it's a REIT, revenue up 6.2%. Funds from operations for them, they were able to get up about 3.9%. If you look at kind of activity, they bought about $180 million in properties with initial cash cap rates on those of 2.7%, sold off some lower cash cap rate properties that were at 5.1%. So they sold off maybe $30 million there. And, as you look at it, the average on those properties that they were buying, I believe, is about 10 years. Stock coming off of that report, we're looking at down about 4 or 5% since earnings.
National Retail falls in this category of triple net, and it's actually their stock ticker, NNN, triple net. And so basically the way these properties work is the tenant pays almost all the expenses, which is a great inflation hedge in my opinion, because as the landlord, all you have is your financing cost, and then there's some costs obviously associated with holding the property, but it's really just I think it's a good inflation play. And a lot of the national retail properties are in sectors and even companies. I can read some of the top tenants they have that really are going to be fine, I think, long term. Look at their top one is 7-Eleven, Mr. Car Wash, Camping World, LA Fitness, which LA Fitness is a little concerning. I see them closing down all the time. I think they've got some trouble post-COVID, mismanaged the risk there, I think. Planet Fitness fared a lot better. But then Dave & Buster's, haven't been to one of those in a while. AMC, 2.8% position there. So you've got a lot of exposure to, I think, just good long-term business models. The question now is going to be, and I think this is what all these REITs are facing, is how do you finance these properties? Commercial, first of all, I was talking to a commercial banker here in the area not too long ago. He says deal volume is really slowing down, which is concerning. It's very tough to be a commercial person, but I think a lot of the net lease trade-off has been overdone. I think it's kind of gotten looped into the whole commercial space, where you see all those reports come out of the top Wall Street banks saying that commercial is in big trouble. If you actually peel back the layers of the onion on those reports, they're mostly talking office space. So I think net lease, I think like National Retail and WP Carey and some of these other ones, they've unfairly gotten looped into that whole trade-off. And look at the dividends. You're getting 5.5%, almost 6% dividends, and I do like it. I think as an inflation play, we'll be able to refi these properties at some point in the future. So you may see a short-term hit on earnings. That's why they're down a little bit off all-time peak levels. But I think that actually represents a buying opportunity. Don't overdo it again, but I do think there's a buying opportunity on some of these.
Mm-hmm. Yeah, well, there's a lot of headline risk in the commercial space, and a lot of times you do see people just broadly treat it as one thing, even though there's so many different niches and sectors within it. I did misquote the 10 years, so that was actually to your point about owning some great companies or the properties that they're invested in. They have occupancy levels sitting at about 99% right now, and the weighted average remaining lease on those is 10.2 years. So, yeah, I would second your thoughts there. Next and last here, we'll jump into Qualcomm. Revenue for them was down about 23%. They got two sections, the Qualcomm Technologies and then their technology licensing piece of it. So their technology piece, which has sales from the products, services, chips, things like that, was down about 24%. Their licensing side of things were down about 19%. If we look at the technology piece from a revenue stream perspective, handsets were down about 25%. Internet of Things was down 24%. They did see automotive up 13%. That is their smallest piece of it still, but it was the 11th straight quarter of year-over-year double-digit percentage growth in their revenue in the automotive space. So net income and earnings per share was down just about 50%. Stock, as we're looking at it today, is down a little under 9%, primarily a result of those smartphone chip sales. We did see reports of some potential layoffs there.
Yeah, I've always liked the Qualcomm story for a number of reasons. I remember being out in San Diego years ago and going past the headquarters, and then I really started researching the stock, became an investor, and I like it. I think they're in the right space at the right time, and AI is big to their business, and we kind of joke about AI, but here's where I think Qualcomm fits in, and it's the fact that they're in this investing thesis of being the pipes and wires. I don't know if you've looked at some of those stocks, Sam, but instead of being like for example in the oil business, ExxonMobil or Chevron, rather owning the pipelines or something like that, or like the equipment they use, that's been a very good place in general. That's sort of the Warren Buffett approach, is you own the pipes and wires that all these guys have to use. Like during the gold rush, when everybody was heading out west, you sell them, the pans, right? or something, or you open up a hotel where they're all going to stay. Those are the businesses that I really like, and I think Qualcomm is sort of like the pipes and wires for the tech revolution, 5G, AI, a lot of the Bluetooth stuff out there, Wi-Fi, camera equipment, all these types of things, processing. That is a nice little spot to be. Stock's up 85% without the dividend, and I still would consider this a tech company, and it's got a 2.67% dividend. You can't beat it. So you're going to see a little softness, I think, with all the headline risk going on in Taiwan. I think that's largely overdone. I think China's actually got some serious problems ahead of it. I think they're facing some significant headwinds. So who knows? Maybe I'm wrong. Maybe they invade Taiwan. I've been talking about this for a long time. Certainly that would hurt a company like Qualcomm or some of these other ones. So I think that's the headline risk. But long term, if you can get past that, look at the revenue, look at the net income. They're doing very well, and they're trading still at a very reasonable price to earnings ratio. So I do like the stock.
Great. Well, thank you, Nick, for sharing the thoughts there. Remember, everybody, if you like the show, please subscribe, share it with other people that you think would enjoy it. Next week, we're going to be covering another 15. We've got Generac, Exelon, Coinbase, Amazon, Apple, ConocoPhillips, Papa John's, Occidental, Shake Shack, Wayfair, Cigna, Air Products, Monster, Eli Lilly, and Disney. If you'd like to learn more about Stenger Family Office, visit our website. Give us a call at 630-912-8431 to request a complimentary starter kit and learn how you can get a starter account going with us for just $1,000. We do have 3 events coming up. September 7th at Gibson's in Oak Brook with the legendary Dr. Jeremy Siegel live there. September 20th, we're going to be hosting a happy hour down in Spring, Texas to celebrate the opening of our new office down there. If you're in Houston, we would love to see you there. And then November 14th and 15th, we have our annual Investor Day at Hotel Indigo up here in Naperville. Thank you for listening, and we hope you have a great week.